March is off to a soaring start right now as the markets rally today, ending an up week and ending a 3-week losing streak for the S&P 500. After a dismal February, it's great to see the bulls are back running again on Wall Street. Welcome everyone to Buy, Hold, Sell. I'm your trader, Todd Schoenberger, and I am joined by my friend and co-host from sunny and hot Scottsdale, Arizona, Tobin Smith.
Oh,
and I know
idiot.
You can say it's cold all you want. I know it's warm out there. It's cold in New York. I think it's too cold in New York.
It's always cold in New York. Go ahead.
There you go. All right, and
Gina.
we have a guest on the show. It's clear that Buy, Hold, Sell has actually raised the level of gravitas. Finally, we have reached that spot that we've been dying to get to for the past year. We have an excellent guest. Gina Martin Adams, Chief Equity Strategist at Bloomberg Intelligence, is joining the show. Gina, welcome to Buy, Hold, Sell.
Thank you. I appreciate that. Thank
Yeah, he's had a little coffee today, Gina, and he's now changed the name of the show to Buy, Hold, and Fluff. So that's awesome.
It's all about the marketing.
That's okay. It's been a while since we had a nice full run here.
Yeah, right.
It's been a good one.
There you go. Well, let's talk about that a little bit. So you had January. We had the January barometer, the trifecta hits. It's pointing to all signals are pointing north, thinking that this is going to be a wonderful year for the markets in 2023. And yet February was an off month. But what do you think right now? I mean, is the leadership really there on the equity side that can really push this market even higher?
You know, I think it is going to be a little bit of a year of rotation, so I don't want to dampen the party mood too much. I do think that January was a very strong start and a continuation of a new uptrend that began in October. So let's set that out there to start with. We did see a major sentiment washout as of October. Sentiment washouts usually make bottoms in the equity market. And January for us was a continuation of a better trading environment emerging for 2023, at least relative to 2022. That said, we got a bit ahead of ourselves by the end of January, where we're trading in very overbought conditions. We were starting to lose a bit of momentum. Clearly, the junky nature of the January rally created a little bit of concern in the market, and we naturally removed some of that optimism in February. Now, as of March, our signals are suggesting we're net neutral. The equity market has bounced off of a 200-day moving average, which is a very critical level for the S&P 500. But notably, small caps are still leading, and that is a very key sign to watch. If small caps are continuing to lead, small caps are not making lower lows, continuing to lead the progress in the broader equity market, it's a signal to watch. That's been confirmed by other cyclicals. Continuing to lead in the equity market, financials, industrials, consumer discretionary stocks, the stocks that nobody talks about because we've been so captivated by tech and energy are still starting to break out and break higher. Those suggest to us that the market is rotating into some form of a cyclical recovery trade. Are we going to get double-digit growth? It seems incredibly unlikely considering the environment of still persistent inflation and higher interest rates. But we could have a reasonable year in 2023 relative to 2022.
Wow. That's go ahead, Toby. Go ahead.
I'll take the other side of that trade.
Okay.
I mean, first off, Gina, I think it's great to have you. And I think it's interesting that in the technical analysis that we do and the people that I follow, I kept getting all these texts. I manage everything by text, and I sort of find the vibe by text. And it was on the second. And everybody said, boom, we hit the bottom. We hit the 10-month moving average, which is, typically in recessions, that's one of the key indicators, obviously the 200-day, et cetera. We didn't have Rosenberg on, but when I talked to him on Monday, his whole thing is, but if you take the 5 largest market cap tech stocks out of the S&P 500, we're still below it. I said, well, that's sort of cherry picking, Rosie, but it is intriguing. And then what I didn't mention was what you just mentioned. Yeah, but if you look at the small cap, one would think that that means the dollar's coming down somewhat, right? Because from an import standpoint, they were getting hurt a little bit. But the big issue that I think we keep missing, I think the market is missing. The Dallas Fed on Monday came out and one of their Minneapolis Fed, one of the crazy little things they do, because they got 110 PhD economists, so they got to do something, was that they looked at my brain just they looked at the fact.
Get it out.
Yeah, I know. When they do the math, like I do the math, A+ in calculus, D- in algebra, that it's not possible with the sticky inflation and base effects to get to 2% inflation without a recession. They put it at the last part of their report, came out on Monday. Nobody's talked about it because nobody reads that stuff, but I read it. And I thought it was intriguing, though, to hear a Fed official look you basically in the eye and say, by the way, what we can't say is we have to create a recession because there's no way we can have 2 jobs for every, one person available. There's no way that, rent and shelter costs, which lag everything by 6 to 9 months, there's just no way we can get there. And on the other hand, the Fed can't say, oh, by the way, did we say 2% inflation? No. We meant 3%, because then the whole bond market goes to hell. So
Right.
Take on that.
No, I think it's a very good point, and a couple of things come to mind immediately. First is, you're absolutely right that as long as inflation remains hotter than the Fed would like to see, we have this ongoing pressure on interest rates. The market, at least the bond market, does seem to be pretty confident in this notion that the Fed is actually going to reverse policy later this year as the economy weakens over the course of 2023, and that is still a risk to the equity market. But at the same time, I think you do need to very carefully decompose the equity market when you're talking about it, right? The S&P 500 trades at 18 times earnings, but if you remove the biggest stocks, you remove tech stocks, you're looking at an equal weighted index that's trading at 15 times earnings, right, which implies that you should be paying about what you'd pay for if CPI was around 4. So outside of big cap tech stocks, which are obviously distorting the valuation view for the S&P 500, you do see the market trading at a more rational level of expectations for inflation. I do, though, want to moderate my expectations for 2023 because I do think that valuations are going to remain somewhat capped by this idea that interest rates are going higher. Now, separately, you look at the earnings situation, it's very clear to us in our models, and as was as of October, that the equity market at that point in time was already trading on the idea that we were falling into recession in 2020.
Right.
And this is something that I think that nobody in the consensus really wants to point to. Everyone says, well, the market's not priced for recession, forgetting that the equity market prices in recession once and then starts to move on and price the prospects for recovery. And I do think that what happened is we priced this recession. We've been talking about this recession emerge for a full year.
Right.
So that was a lot of what the risk of 2022 was. Yeah. And small caps in particular, as I highlighted earlier, are trading at 2 standard deviations below large caps, have been in a bear market for nearly 2 years already. Small caps are very well prepared for this so-called recession that's emerging in 2023. And I think that's what you're seeing play out in the equity market.
Well, that was interesting.
The problem we have going forward is how much of a recovery can we get going into 2024 and 2025? And that's where I think we want to moderate our return expectations. Our models would say, unlike the last cycle where you got 11% annualized returns to the equity market, you probably get closer to 6% annualized returns this time around.
Well, wow.
That means that you have more of a choppy kind of market emerge. And that largely reflects those structural conditions that you spoke to, where the Fed is really struggling to get inflation back to that 2% bogey. We may be in an environment for a long period of time where we see inflation well above 3 or even 4%. What that means for interest rates is going to create complications for the equity market without a doubt. Yeah. But it creates complications for some stocks in the equity market more than other stocks. It means a choppy large cap market outlook, but it might mean a very positive small cap market outlook.
Yeah. Hey, Gina, how do you then handicap the China reopen? Because in essence, now that becomes the hinge for oil. Yeah. That becomes the hinge for, we're big into energy tankers. We called it the Brexit trade last year. And God, when you make 250% from a 35 million market cap to a 200 million, you feel pretty smart, right? Well, now we're at that point where we've been selling them just simply to protect the profits. But that China reopen is really the thing that would drive steel, would drive oil, would drive LPG, chemicals, et cetera. What's your take?
Yeah, I actually completely agree. There are plays.
Can we have her on again, Todd? I've never had anybody completely agree. Ever.
I think though that the evidence is pretty clear already in the equity market, in the commodities market. And we published on this actually today, talking about the signals of the commodities market that are meaningful for the equity market. A couple really come to mind. The first is copper relative to gold. has been rallying since October. Copper relative to gold is a very good risk tolerance sign. It suggests that if risk tolerance is improving, probably demand conditions for those metals are starting to improve. Copper, as the ultimate Dr. Copper economic indicator, is telling us something at this moment in time, and it probably is tying to the China story. Now, obviously, only about 5% of overall revenues on the S&P 500 actually come from China. So the S&P 500 is not your best China play. Your best China play is really international equities, in particular emerging equities related to China, maybe even Australian equities, maybe some Canadian equities, given that they're resource kind of economies. But nonetheless, it is an overall signal of better performance likely coming. I do think that it could complicate the inflation scenario, and this is something we watch for to play out in valuations for sure. Oil prices so far are also relatively contained, though, even though the China reopen story has perhaps put a floor under oil prices. Oil prices are still down
sold
about
85 million barrels of oil, for no reason other than political, gain, right? So fresh oil prices, right?
I think if the positive news of that, frankly, is if oil prices are contained, they're down 40% from their peak.
Yeah.
Oil prices always peak in the middle of recession. And this is a very consistent factor that goes back decades. If you look at 1991, you look at 2009, 2008, 2009, even look at 2020, that oil price peak in the middle of 2022 may be telling you something. Oil prices down 40% are actually a potential reinvigorator of the cycle that nobody's paying attention to right now.
Todd,
so I think you want to watch really carefully.
By the way, I'd like to work if that is that a real world?
Gina's given us some amazing hot takes, and yes, reinvigorating will be the key word. Hashtag, We'll start a movement with that.
But I think it's worth noting because every recession we've had has included some distress in the consumer space related to the price of gas at the pump. If that distress is removed as a result of oil prices coming lower, today the consumer has a little bit of breathing room going into the spring and summer months relative to where they were in 2022. And nobody's talking about this factor. That said, this is the risk, right? If China does come back online and comes on hard and fast, the result is we could see oil prices reaccelerate into the summer months. And I would view that as actually a risk to the overall equity market because it may put us back into a much greater degree of distress economically.
Well, also, let's not, discount the fact that they had their PMI was 5.7, the highest gain in a purchasing manager index ever. So that means they're going that. Australia now can ship their coal to China because China finally said, "Oh, we're so sorry. We outlawed your coal for 2 years, and now we're running out of it." Well, they only run out of coal. I don't know how many times you've been to China, but I've been there a lot. You just go by the air quality in Beijing. And I have a colleague over there, and I always text him every other month and say, "I mean, how many lungs have you gone through so far?" And he said, "Dude, this is the cleanest air I've ever seen." And then last couple of weeks ago, he said, "We're back to the crappy, killing fogs, quote unquote, which is smog." So I'm just intrigued that the China bit, we're going to get more information. But what about the jobs? I mean, is this next jobs thing not the biggest one we have?
Actually, let me stop you right there. Let me stop you right there because that's a great segue. We'll do that in the next block because I do want to get your thoughts on that, Gina, especially after the eye-popping number we just had. We got the big jobs report coming out next week. Jerome Powell's going to have his grill on the Hill. He has to head to Capitol Hill next week. There's a lot of moving things that are taking place that can move the needle next week. But listen, please stick with us. We have Gina Martin Adams, Chief Equity Strategist from Bloomberg Intelligence, joining the show. We will be right back after the break.
Buy, hold, sell, brought to you by CrossCheck Management.
Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in your face, rock and roll style.
Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember. Oh, God. Yeah, well, that does. I want you to, oh, my God. Fast pace, no, oh, sorry.
Take one.
Fast pace, no holds barred, in your face rock and roll style.
Woohoo! Let's kick some ass.
I want you to smash that like button.
Track, cue, dissolve.
Good morning and welcome
From Bigwig Studios. From the Bigwig Media Studio.
Bigwig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences.
Kudos to our team who's running around behind the cameras.
What I liked about working with Bigwig Media was you guys are the experts.
Our industry pros have you covered. Let's get started.
Market start today, Friday, March 3rd, 2023. We had the S&P 500 having its first positive week in the last 4, both rising 1.9%. Sensational because we saw so many dire moments in February. January was a big month, but we have the best of the best with us right now on Buy, Hold, Sell. We have Gina Martin Adams, Chief Equity Strategist from Bloomberg Intelligence. And Gina, right when we ended the last break, Toby brought up about the upcoming jobs report. It will be next. So on Friday, March 10th, normally it would be on the first Friday, but I think because of the jobless claims, you know better than we do. But I think there was some type of a hiccup because it was so close to the end of the month. But here we're going to have this on the 10th. The consensus on Wall Street right now is looking at 225,000 jobs created in the month of February, which I still think is astonishing considering that we're supposed to be in this recessionary environment. But this would be on the heels of last month's January's 517,000 number. So what do you think? I mean, being the strategist, I'm sure you're getting a number of people that are asking you how the jobs market is going to move the needle, because I would think if we do hit 225, that's still going to be a signal that the Fed might have to hike higher than the 25 basis point that's expected.
Well, I think what's happening in the job market is really intriguing. So I'm glad you brought it up because it is on everyone's minds. I mean, I think that the most important data point that I can share with you today is really with respect to the degree of layoffs that were announced over the course of the fourth quarter earnings season. We did track more than 100,000 layoffs announced by S&P 500 companies just in that earnings season alone. And that's only S&P 500 companies, so certainly not for the population at large. We are likely to see initial jobless claims start to hook a little bit higher over the course of the next 6 months, and we will most likely see the unemployment rate rise a touch as well. That said, the job market has been surprisingly resilient and may continue to be surprisingly resilient because of the unique dynamics of this recession recovery experience. The thing I think you want to watch for, frankly, the thing that really matters most is what's happening with wages, because there is some degree of uncertainty with respect to a potential wage price spiral developing. And I think that that's what the Fed is focused on more than anything. Remember, we just came off of a month as well where we repriced Fed funds expectations because of the inflation numbers. So a lot of this is where have you been versus what's priced in the market coming into January. The number took everybody by surprise, without a doubt. We reset our expectations for employment growth to be a little bit more positive. We then reset our expectations for inflation to remain hotter. So I would actually be on guard for what's going to happen with wage growth, because if wage growth is somewhat disappointing, the market could actually respond relatively positively to the employment numbers. The 200,000 handle is still very steady. I totally agree with you. Relative to 500,000, it may not sound so splashy. 500,000, I think, is unsustainable. But if we keep getting 200,000 and we keep seeing wage growth, it will pressure the inflation expectations. It will pressure the bond market to reconsider, where it thinks the ultimate terminal rate may be. And it probably will infuse a degree of volatility in the equity market. But I can't stress enough, I think it's about wages. The job numbers themselves get revised a lot over time anyway. The Fed is going to watch wages and they're going to watch the inflation numbers more than anything.
Yeah, Todd, also, add to that I think people sort of forget that we're like a 73 to 76% service economy, and those service jobs are the ones that are driving it. I don't think the Fed's worried about, guys on the manufacturing line since it's such a small number. And that was where, the wage spiral was in the 70s, because, in the early 80s is that they had cost of living adjustment, COLA deals in their union deals. So every time the price went up, their wages went up, and the wage went up, inflation went up, and that became the spiral. I'll still go back to the fact that three things. Number one, of the 155,000, according to information.com, of people who've been laid off by tech in Silicon Valley, and around the world, almost all those people got 3 month to 6 month packages, plus their stock vesting, plus. So they're not going to show up in the unemployment because nobody's claiming unemployment when you've got a severance package. So I pull those out. Then the second part of it is healthcare was the big issue there. Remember that Social Security and Medicare Advantage and so on and so forth, they had the largest uptake in Medicare Advantage we've ever seen in the last 24 months. And that means that more people are covered, and that means people can go wherever the hell they want for service. And we lost 200,000 people in the healthcare business. So and then the third one, of course, would just be that everybody with hair my color has quit. I'm the only guy I know, from college who's still freaking working. The loss of first off, 1.5 million, Zoomers, 21 to 32, they're gone. What are they sitting playing, e-games all the time? Then the other side is the over 60 numbers is down about 2.5 million. So Gina, where I sort of lose, oh, by the way, we're down 1.5 million immigrants. So unless the Fed could, like 3D print people, I don't see this dynamic changing. And the only way you get people off their ass, particularly out of the basement playing, a Game of Thrones, or I don't know, is to pay them more. And then once you pay them more, it takes you time to train them, so their productivity is low. Blah, blah, blah. The Fed is not going to see any number that's going to scare them other than if we get to the 250, 300,000 jobs again, which we certainly could, because that also is skewed in the first part of the year. Then they have nowhere to go. It's the old thing. Good news used to be good news. Bad news used to be bad news.
Yeah.
Then we had bad news was good news. And I that's why, I used to have dark hair when we started this show, because, you have to, the narrative, right, is driven by the algos. It's not driven by anything else. If the algorithm says, good economic news means the Fed's going to keep raising, sell, right? And then sometimes you get bad news, and that's good news because that says the Fed's going to stop. And it flips back. It's like a ping pong game. That's why I think we're range bound, number one. But then number two, I will say this, and again, going back to this example of tankers, we have some secular changes that have happened in our economy, in the world economy. The global de-globalization is on like Donkey Kong here, and that's not slowing down. We're buying these tankers at 3 PEs, generating 25% annual dividends. I just was with a client today. We put $3.5 million to work in the average PEs of 4, with dividends averaging 22%. And I'm telling you, just hang on till June when the Fed's done, and then we're going to buy mortgage REITs and everything else that does better when interest rates ultimately come down. If you're tactical right now, we're crushing it. But if you're just buying the index, to Gina's point, hey man, you have no edge on anybody else.
Yeah. Well, Gina, how about that? Because right now, when you start, you were talking about the health of the consumer when you were really getting into your analysis there with the jobs report. And we just had the big retailers release their earnings. Actually, this week we had Walmart last week. It's clear that, it's clear. It's definitely some weakness. I mean, I know Target beat their analyst report, but when you start looking at that health of the consumer, and then you talk about the wages, I got to tell you, I mean, we had Nicole Middendorf on the other day. I mean, she was telling us, people are still out there shopping. They're just not holding any shopping bags. So
No, they
eventually,
have shopping bags. The shopping bags are empty, you bonehead.
shop bags are, yeah. So with that though, going forward, you have to suspect that if people aren't spending, that is going to have where the earnings will not be there on the equity side. Am I correct, or what's your thought?
Well,
For the
I think
retail
it's a
space, but
mix.
it trickles down to all of them. I mean, you can take a look at any sector. If people aren't working, people aren't driving. Therefore, you're going to have oil stocks should be plummeting.
Yeah, well, without a doubt, we are experiencing some degree of slowdown. I mean, we did have even revenues expectations were reduced by analysts across the S&P 500 for the next 3 quarters. So we are starting to see some degree of volume slowdown. But I think a lot of the volume slowdown is driven by mix shift when it comes to the consumers. Certainly, they're not going out to retail and spending on goods, but they are still spending on services. I mean, I don't know how many airplanes you guys have been on for the last couple of months, but everyone I'm on is packed.
Yeah.
Also, businesses are still spending a lot on services as well. So restaurant reservations still very hard to get. Travel services still definitely hopping. So we are seeing more of a mix shift with a bit of slowdown, certainly at retail, and absolutely a slowdown in durable goods order spending, goods orders growth and durable spending, as you would expect. Interest rates are going higher. Anything that's somewhat dependent upon interest rates is going to get a hit. So housing activity slowing a little bit, autos activity slowing a little bit. Anything that requires a credit card to purchase or financing to purchase is going to get hit hardest in an environment where interest rates are going higher. We should expect that. The thing to really watch, frankly, is the services spending. How much do they slow down their spending on, vacations going into the summer? How much do they, does traffic slow down? Are airlines starting to struggle again? Are restaurants experiencing a lot of open tables, et cetera, because those are the areas of strength right now. If those start to weaken, then we do have to worry a little bit more about the outlook. We just aren't seeing that weakening en masse. I think it is a very mixed story. I mean, frankly, when we look across the S&P 500, it's really astonishing to see the divergence in trends where financials are actually starting to pick up some speed, industrials as well, materials doing reasonably well. Energy obviously had a fantastic 2022. It's coming off of that. But generally, these profits of these companies are still holding in quite consistently higher. The areas of weakness are the areas that used to be strength. So tech, we spent so much money on tech in the pandemic. That's all we cared about. We were all completely captive. And so the concentration of spending was in that space. And now that's experiencing the downdraft. This goes back to something we were talking about. The unique aspects of this pandemic and pandemic recovery are really playing out across the S&P 500. And it is very much an idiosyncratic story in a lot of ways. I mean, there are some very strong winners in the index, and there are also some very big losers. That played out throughout 2022. I don't think that's going to change in 2023.
Well, also, let's be clear. This post-pandemic weirdness, I think, is what David at JP Morgan called, which I sent him a note. I said, "You stole my line, you jag." But the weirdness is now sort of not weird. I would just call this, I have a portfolio, the index that I run, it's called the GMOOF, which is basically get me the freak out of here because if I travel, and it's at the higher end. I own American Express. Why? Because, every $8,000 seaborne cruise that every one of my friends other than me has been on in the last 2 months, they're spending 8 to 10, 15 grand to go down to the Galapagos, et cetera. Why? Get me the freak out of my area. Get me out of my house. Get me out of, this thing. And I have the financial wherewithal to do it. So at the high end, I totally get that. On the other side of it, the trading down of premium to, buying more food at Walmart than buying clothes, et cetera. And again, perfectly makes sense. We had to build another closet just for the clothes we bought in the freaking pandemic, right? For all the other stuff, you added. But on a continuing base, I guess we try to use a base effect in a year over year deal. The restaurants are still kicking butt. If you look at those stocks, Gina, from following them, Wingstop's my favorite. Wingstop is both value and sloth at the same time, which to me is basically the story of America. And, Todd has his kids and the 1,200 lacrosse players coming over to his house. What are you going to do? Hello, Wingstop. All right, send me 12 bucks. And they're going to eat them all, right? But Wingstop also has a new chicken sandwich. I'm getting very, binary here. And the new chicken sandwich is great. Well, based on that scientific analysis, we purchased Wingstop a couple of months ago. Stock's up 40%. It was selling at about a 4 PE if you took forward, ratings on it. And it's the value buy. For $10, you could feed both of your kids. Your kids eat like they're going to the electric chair.
Listen, okay.
To add on to that, just think about the dynamics of now Southeast Asia and China is just getting started in their recovery process, right? And so you think about how Americans and Europeans really started to get out and spend on services over the course of the last year. We're just entering that wave for much of Southeast Asia, which has been largely locked down, in particular China, but not just China. A lot of peripheral economies in Southeast Asia were very, very slow to sort of come back online, maintained some degree of extreme conservatism with respect to moving around. And now that spending power has also been unlocked. So I think when you think globally, we can't think of a sort of synchronized recovery anymore. We have to think of the sequential waves of recovery, and Southeast Asia is just experiencing them.
Yeah, I mean, go ahead. I would say we're also off Starbucks, by the way, because Starbucks opened up 4,500 stores in China that were closed. I mean, I not be a wise man, but they got to have more sales this year than last year.
Right.
Well, Gina, question for you. So domestically, I mean, well, first of all, at Bloomberg, you have access to the all-star team of analysts. I mean, you got Mike McKee right there. I mean, I'm a big fan of. So what is everybody saying internally at Bloomberg? I mean, there's got to be pockets geographically around the country that are much softer, much weaker than other parts. I mean, you talked about restaurants being packed. Now, I know you travel a lot, but I would imagine New York City, you're walking on Lexington Avenue. It's not exactly I don't think there's a mirror image of Lexington Avenue to what the parts of the Midwest, for example. There's got to be a slowdown. University of Florida, I mean, Southeast, I mean, is the Southeast booming? Because I would think that it is. Yeah. We hear things, but we don't know. What do you think, or what's everybody talking about at Bloomberg that's saying, yeah, these areas of the country are weaker than others?
The only area of the country that I've heard people talk about as being weak is actually San Francisco.
Yeah.
And I think that this is very reflective of what's been going on in tech, and also reflective of the fact that San Francisco really never got back to life following the pandemic because there was no real return to work. There was no real return to office in downtown San Francisco. So what I do hear is in that Bay Area, some significant weakness definitely has emerged. I have not heard of other areas of the country, frankly, as emerging weaker. I was just down in Texas earlier this week. I was in Austin and San Antonio. Things are definitely booming there.
Boy, no
I was in San Diego and Southern California 2 weeks ago. Things were definitely booming there. Chicago has been in fits and starts in similar fashion to New York, definitely struggling with the hybrid kind of workplace, and Chicago downtown has been, kind of in this rolling recovery. I would call that similar to Manhattan's rolling recovery, but I have not heard about weakness, or weakness as the characteristic term. The only area that I've honestly heard has weakened substantially and is definitely still struggling to come back from the pandemic is that San Francisco Bay Area.
No question. Hey, Gina, question. So we talked a lot about equities here. Let's talk a little bonds.
Oh no, do we have to?
Let's talk a little bonds. I mean,
that's a 180 to equity.
Yeah, I am the equity strategist. So
I know, but as an equity strategist, you have to have a position on where rates are going to be and where the bond, because at some point in time, we're calling it like the great, Mambo shift. When the Fed ends, and we think it should, and by the way, the terminal rate I'm using is 5.75 to 6% for a variety of reasons. But man, there's going to be some wonderful bargains in as interest rates start to come down in those interest rate businesses, mortgage REITs, mortgage lenders. Here in Scottsdale, Greater Arizona, there's a restaurant where all the ex-mortgage brokers hang out, and it holds about 800 people. About 700 of the people are those mortgage brokers, right? Real estate people, so on and so forth. If rates start to come down, what do I want to buy when interest rates have finally peaked is what I'm asking.
Yeah, no, I think it's a great question. The most interest rate sensitive segments of the market tend to be the financials, consumer discretionary, and industrial sectors, where rates are pretty consequential to the outlook for earnings growth. So when I'm thinking about the equity market and sensitivity to interest rates, what's really interesting about the equity market, recall when we first started talking, I was talking about some rotation into these very sectors already. So the equity market is already starting to think about the point in time when interest rates have finally peaked, which is not totally unusual.
Yeah.
The equity market can move up to 12 months in advance of the overall economy. It's obviously had a lot of time to adjust to the idea of higher rates. But these are the areas that are definitely the most interest rate sensitive in the equity market. I think small caps could also get a tremendous lift off of that. There is this general, it's more of a sentiment headwind than a real headwind. But small caps from a sentiment perspective are very tied to interest rates because there's a perception of the cost of funds being incredibly important to small caps. You and I know that energy is a big part of that story, and energy certainly has no scarcity of funding at this moment in time. They've been cash flow hoarders of this giant cash hoard that they've developed over the course of the last year.
Boy,
So
that's
there's
hard
very
to say.
limited risk
You got to
of,
get that
a
D
default
really
cycle
hard,
there.
because other it sounds like that they're cash whores. You know that. I mean, you really got to hit that consonant. Hey, so look at we just bought. We're starting to build a position in a firm, which was only a $225 stock, 18 months ago. Now it's 18, because of exactly what you said, that on a firm you can, they charge your interest rate to the seller. You divide your payment into 4 payments or 6 payments. And I get a note from a credit agency that follows all this stuff. And both PayPal now has the same thing, and a firm. And they said on Amazon, which is, sort of the big kahuna here, they said they've seen the transactions up about 30% over the last 3 to 4 months, because people are discovering this, buy now, pay later. And the young kids don't do credit cards any longer, right? So any thoughts on buy now, pay later? Have you followed that space at all?
It's a little bit too narrow for me to follow. I'm sure there's a Bloomberg Intelligence analyst that I could refer you to.
Okay, good.
That said, I will say this much: when we run scorecards for the sectors, relative sector allocation as well as industry allocation within sectors, and intriguingly, within the financial sector, consumer finance industries at large have popped to the top of our scorecards. So that is consistent with a theory that there will be a little bit more activity, a little bit more revenue growth for financing companies.
And the other question is for me or to you is leading indicators. So I'm a Rosie fan. Dave Rosenberg and I, go way back. And when he was at Merrill, for crying out, that's how old I am. And he's all jiggy on the leading indicators, because the leading indicators are showing that, we're going this way, not this way. Do you follow the leading indicators? Is that a big part of your stuff?
So I have a select list of leading indicators of my own that I like. The leading indicators index is the composite index. I presume that's what we're talking about here. I actually like the leading indicators of the market internals themselves. So back to my technicians group.
Yeah.
I like to follow things like what are semiconductor stocks doing? What are transportation stocks doing? What are home builders stocks doing as leading indicators for the equity market itself? Because frankly, the equity market is always going to be in front of the economy. And so the leading economic indicators are only so useful in pockets. The leading indicators within the equity markets, the internals such as small caps, all of them are breaking higher.
Yeah.
And that probably tells you a little something about risk tolerance right now. It's in a state of improvement for sure, but it is rare, frankly, to find a point in time in this early in a potential recovery cycle where all 3 of those major industry groups, home builders, transports, and semiconductors, are breaking out of downtrend. It's usually 2 of 3. You've always got one laggard that's making you wonder if the call is right. This time it's 3 of 3, which does say a lot about how oversold and how much sentiment washout we had throughout 2022 in anticipation of the weak economic climate that we're having in 2023.
Well, explain to the listeners, viewers, what oversold means and what, because it's a big issue.
Yeah, so let me just start with this. We run our own proprietary survey of market internals, and we call it the Market Pulse Index. And what we've done with this thing is we've taken every indicator that we can find in the market and tested it for its value in determining ultimate sentiment highs and lows in the equity market. And as of October, the equity market pulse was basically at 0. We take things like volatility in the equity market, correlations between stocks, the performance of high leverage versus low leverage stocks, the performance of defensive versus cyclical sectors. And it's a laundry list, but nonetheless, we put it all together. October's low was as low as the 2009 low, just to give you a sense of how bad sentiment was in October.
Do I need to spend $1,500 a month to get my Bloomberg terminal? To get that?
You better get that Bloomberg
22.
subscription so you can follow it.
$22.50, $22.50, Toad.
Okay, all right.
You know, the other thing that I would say is it's just rare. It's very rare that you have a signal that is that clear that sentiment was that washed out. And
Yeah.
I think that the results of the market rally since is a function of that sentiment washout more than anything else. We had basically given up on the equity market at that point in time. It doesn't mean that the rally can't, you know, end at oversold or overbought conditions, and we might go into a more choppy period. That certainly is possible, but that oversold signal was very, very important. Now, when I think about oversold and overbought, I tend to think of those terms as more near-term indications. And what we did see as of January, for instance, we got to a point of very overbought levels where 14-day RSI, which is just a momentum indicator, and the index was a bit overdone. MACD, which is a moving average crossover of convergence divergence lines, that crossed under. So there's some technicals that I use to describe overbought and oversold conditions. I think most of them are very short-term in nature, so I don't use them for a longer-term thought process. But the market signals index was really important to driving our thought process as of the October
What's
low.
interesting to me is that exactly what you described about the sentiment being just, you know, I try to explain to people just saying everybody who had to sell has sold. And that at some point in time, the people who don't sell for a variety of reasons, particularly the 78% of the market that's owned by pensions and so on and so forth, there's nobody else to sell. You don't have to sell. You don't want to sell. Blah blah blah. That to me is this oversold. But the sentiment of the retail, you know, the FOMO, et cetera, that's really at the margin, not the big deal. It's the big guns, right? It's the hedge funds, the pensions, et cetera, that are driving this.
Yeah. Which is why we use those market internals, because the market internals tell you everything you need to know about sentiment. I mean, this is the one trouble with sentiment is everybody has their favorite indicator. So a lot of people, for instance, use flows. I've found flows to be quite meaningless as an indicator. The FOMO trade is exhibited best in meme stocks. So we do follow the meme stock crowd, but meme stocks aren't indicative as a market indicator of themselves either. They indicate themselves, but they don't indicate anything about the broader market. So what we try to do is isolate the true sentiment drivers by analyzing the market internals and analyzing how stocks are behaving relative to one another and how stocks themselves are behaving, rather different segments of the market are behaving. And I think that's, to me, it's a much better, much more quantifiable signal that I can use. And it actually has proven its worth for me once again with that October signal.
Yeah. Todd, JC Peretz, you know, he came in and he said, you know, JC, well, let me tell you, the actual low was in June of 2022. I'm perfect proof. I don't know why people will listen to me. And then he said again in October, you know, he got the same, you know, reading. So we basically had the double bottom. But he claims that we had the technical bottom June 16th, I think it was. And you know what? If you go look at it, he was right. Now, if you overlay,
he's not wrong.
Yeah,
he's not wrong at all, because that's when the small cap index.
Cap, right? Well, when you
he is not at all wrong.
Yeah,
that's the other thing that I think is really difficult in our business is we tend to get very captivated by what's happening in the S&P 500. The S&P 500 at times is very skewed by heavy market weight. Market cap concentrations. And over the last couple of years, it got even more skewed. So really the S&P 500 in a lot of ways only gives you a view of what's happening with its biggest stocks, especially at the peak in 2021. It was really just what's happening with Apple and Microsoft and Tesla and Amazon, because that was all that drove the index. That's changing, because we're having some shifting market cap concentrations right now, but it still doesn't give you a view of what's really happening in the broad markets. That's why we do lean on small caps as well. So in this instance, I would not argue with JC.
Mr. Teacher,
Yeah.
I just learned a great lesson. Thank you very much.
There you go. We
Start
all
working
did.
it.
We all did. And the audience. And Toby, on a side note here, I just got an email from JC. He loved the impersonation. So that was wonderful. That was great. So listen, guys, we're going to leave it there. So a wonderful show. Gina Martin Adams, thank you so much for joining us today on Buy, Hold, Sell. Can't thank you enough. You definitely raised the level of knowledge for our audience. That's for sure. So listen. Thank you. So on behalf of Gina Martin Adams and Tobin Smith, I am Todd Schoenberger. Thank you again for joining us today on Buy, Hold, Sell. We'll catch you next week. Take care.
Cheers.
Buy, Hold, Sell Live, brought to you by Transformity Research.
I want you to smash that like button.